In just 47 seconds, $850 billion vanished from global markets. I didn't expect this outcome. I blocked the European Central Bank's emergency request. Cameras captured everything. The financial world froze. What did I discover in that classified briefing that made me refuse the most powerful central bank in Europe? Before we go any further, I need you to understand something. I am Jerome Powell, Chairman of the Federal Reserve, and what I'm about to tell you happened behind closed doors in the most secretive meeting of my career. This isn't about monetary policy theory or academic economics. This is about the moment when I had to choose between protecting American financial sovereignty and preventing a global economic catastrophe. The call came at exactly 3:17 a.m. Eastern Time on December 8, 2025. Christine Lagarde, President of the European Central Bank, was on the line. Her voice carried an urgency I had never heard before, not even during the worst days of the COVID pandemic or the 2008 financial crisis. She spoke rapidly, switching between English and French, her usual diplomatic composure completely shattered. The European banking system was on the verge of collapse. They needed emergency dollar liquidity. They needed it immediately, and they needed the Federal Reserve to authorize a swap line worth $850 billion. I sat in my office processing what I was hearing. The European Central Bank had made critical errors. According to classified intelligence I had received hours earlier, they had secretly coordinated with Chinese financial institutions to establish shadow banking networks bypassing American oversight. They had created a parallel dollar system operating independently of Federal Reserve monitoring. Something had gone catastrophically wrong. Christine's voice cracked as she explained the situation. European banks had leveraged themselves beyond reasonable limits, using Chinese cryptocurrency networks to hide exposure. When Beijing restricted access to these channels, European institutions found themselves holding worthless digital assets instead of needed dollars. The entire European banking sector faced a liquidity crisis that could trigger bank runs across 27 countries. Emergency sessions were convening in Frankfurt, Brussels, and Berlin. The German chancellor was considering emergency powers. The French president had placed financial regulators under direct control. This wasn't routine coordination. This was admission that Europe had gambled with global financial stability and lost. But there was something else that made my decision both easier and infinitely more difficult. 3 weeks earlier, I had discovered that European financial institutions had been actively working to undermine the dollar's reserve currency status through partnerships with Chinese banks to create alternative settlement systems. The intelligence came from multiple sources. NSA monitoring detected unusual transaction patterns. Treasury analysis revealed coordinated European purchases of Chinese bonds. A European Central Bank whistleblower provided documentation proving the operation was designed to create a Euro-yuan system excluding American oversight. Now they needed our help. They needed the very dollars they had been trying to replace. They needed the Federal Reserve's emergency powers to bail out banks that had been secretly working against American financial interests. Christine's request wasn't just for liquidity. It was for a validation of the existing system they had been trying to destroy. I told her I needed time to consider the request. What I didn't tell her was that my decision was already made. The United States Federal Reserve would not provide emergency support to institutions that had been actively undermining American monetary sovereignty. We would not reward financial betrayal with taxpayer-backed bailouts. The next 47 seconds changed everything. At exactly 9:07 a.m. Brussels time, I formally denied the European Central Bank's request for emergency dollar liquidity support. The decision was transmitted through secure channels to Frankfurt, to the Bank of England, to the Bank of Japan, and to central banks across the globe. Within moments, automated trading systems began reacting to the news. European bank stocks plummeted. Currency markets erupted in chaos. The euro dropped 17% against the dollar in the first 30 minutes of trading. But this was just the beginning. European banks, unable to secure dollar funding from the Federal Reserve, began desperately selling assets to raise cash. Government bonds, corporate securities, real estate holdings, commodity futures, everything was dumped onto markets simultaneously. The selling pressure was so intense that trading systems began malfunctioning. Circuit breakers triggered across European exchanges, but the panic had already spread beyond Europe's borders. Asian markets, opening for their trading day, immediately reflected the chaos. Japanese financial institutions, heavily exposed to European debt, saw their stock prices collapse. Singapore's financial district became a war zone of emergency meetings and desperate phone calls. Hong Kong's currency peg came under attack as investors fled anything connected to European or Chinese financial systems. The most devastating impact came in derivative markets. European banks had used complex financial instruments to hide their true exposure to Chinese digital currency systems. When these positions were forced into liquidation, the interconnected nature of modern finance meant that losses cascaded through every major financial center. Insurance companies, pension funds, sovereign wealth funds, institutions that had seemed completely disconnected from European cryptocurrency speculation, suddenly found themselves holding worthless paper. Within hours, the $850 billion that had vanished from global markets became a conservative estimate. The true losses, hidden in the complex web of international finance, were approaching $2 trillion. Central banks across the globe began emergency interventions, but the damage was already done. The revelation that major European institutions had been secretly collaborating with Chinese financial networks while simultaneously plotting to undermine dollar hegemony had shattered trust in the entire system. I spent the following days in crisis meetings. The president's advisors demanded explanations. Congressional leaders summoned me for briefings. Global media painted me as either the guardian of American financial sovereignty or architect of economic catastrophe. The European Central Bank had gambled that they could transition from dollar dependence while maintaining access to American support during crises. They assumed interconnected finance would make the Federal Reserve reluctant to impose consequences. They were wrong. My decision to block their emergency request sent a message that reverberated through every central bank, every financial ministry, every trading floor across the globe. American monetary policy would not be held hostage by institutions that worked against American interests. The dollar's reserve currency status was not a privilege that could be exploited without consequence. The Federal Reserve's emergency powers would not be used to bail out financial networks designed to circumvent American oversight. The immediate economic consequences were severe. European unemployment spiked as banks collapsed and credit markets froze. Several European Union member states required emergency fiscal support to prevent government bond defaults. The Chinese financial institutions that had partnered with European banks found themselves cut off from dollar-denominated transactions, forcing Beijing to implement capital controls that hadn't been seen since the 1980s. But there were also unexpected benefits. American banks, freed from competition with European institutions that had been operating with hidden Chinese state support, began expanding their international operations. The dollar's position as the dominant reserve currency was actually strengthened as countries that had been considering alternative systems realized the risks of depending on unstable partnerships between European and Chinese financial networks. The crisis also exposed the fundamental weakness in the European Union's financial architecture. Without a truly unified fiscal system, European banks had been forced to rely on Chinese partnerships to achieve the scale necessary to compete with American institutions. When these partnerships collapsed, the inadequacy of European financial integration became undeniable. 3 months later, Christine Lagarde resigned as president of the European Central Bank. Her successor, a former German finance minister, began the process of completely restructuring European monetary policy. The secret Chinese partnerships were terminated, the alternative currency systems were abandoned. Europe returned to a policy of cooperation rather than competition with American financial institutions. China's reaction was swift and decisive. Facing isolation from both American and European financial systems, Beijing announced a complete restructuring of their international banking policies. The shadow networks that had been used to support European institutions were dismantled. Chinese banks were forbidden from participating in any financial arrangements designed to circumvent existing international oversight mechanisms. The global financial system that emerged from this crisis was fundamentally different from what had existed before. The dollar's dominance was no longer taken for granted. It was actively protected. Central bank cooperation was no longer assumed. It required transparency and mutual respect. Most importantly, the interconnected nature of modern finance was recognized as both a source of efficiency and a potential weapon. I often think about those 47 seconds. The moment when denying one request changed the entire architecture of global finance. The moment when protecting American monetary sovereignty required triggering a crisis that could have destroyed the world economy. The moment when the Federal Reserve's credibility was tested not by market forces or political pressure, but by the betrayal of supposed allies. The financial press called it the Powell Doctrine, the principle that American monetary policy would not be compromised by foreign institutions operating against American interests. European newspapers described it as economic warfare disguised as central bank independence. Chinese media portrayed it as proof of American financial imperialism. But for me, sitting in my office overlooking Washington, looking back at that December morning, the decision represents something simpler and more fundamental. It represents the moment when the Federal Reserve remembered that our primary obligation is not to global financial stability in the abstract, but to the American people who depend on the integrity of our monetary system. The $850 billion that vanished from global markets in those 47 seconds was not destroyed. It was a correction. It was the market's recognition that financial systems built on deception and hidden partnerships are inherently unstable. It was the price of learning that cooperation requires honesty and that trust, once broken, cannot be easily repaired. The European Central Bank learned that monetary sovereignty cannot be achieved through secret partnerships and alternative systems. China learned that financial networks designed to circumvent oversight will eventually be discovered and dismantled. The global financial community learned that the Federal Reserve's emergency powers come with obligations that extend beyond crisis management to the protection of the system's fundamental integrity. Today, the global financial system is more transparent and stable. European banks operate with clear oversight. Chinese institutions participate through established channels. The dollar remains the primary reserve currency through demonstrated reliability, but the next crisis is always coming. When it arrives, I hope whoever holds this responsibility will remember those 47 seconds when saying no to supposed allies prevented larger catastrophe. The lesson is simple. In modern finance, cooperation requires transparency. Partnership cannot be built on deception. Sometimes the most important decision is knowing when to say no. Because in those 47 seconds, when $850 billion vanished from global markets, what really happened was that the world learned the true cost of betraying the trust that makes international financial cooperation possible. And sometimes that is a lesson worth paying for.